September 20th, 2023. There's a misconception that, based on what the Federal Reserve does, you can trade completely based on that. And today was a Fed announcement day, and that's not true. If you don't believe me, go look through the past 100, 200, however many Fed days there have been. There's plenty of data out there, and see if we rallied whenever they cut rates. See if we sold off whenever they raise rates. Sometimes that happens, but it's not reliable enough to trade based on that solely. So you need to watch the price action instead of what they're doing. I don't normally even look to see what they did. I just see what's going on in the chart in front of me and trade based on that when I do trade these days. With that being said, a lot of the times I just take Fed days off because, they're just a little bit different. So I just prefer to just not trade these days since they're pretty unusual. With all that being said, we got obviously a big bar on 55. I'm just going to go over to the end of the day. Got a big bar on 55 and bad follow through on 66, 56. Generally, about like 80% of the time, if you're going to get on Fed days, you get a big move down and a big move up. So usually if you get a big sell off, don't sell the close of 55 thinking that we're just going to collapse, because it almost never happens. Expect a pullback because there almost always is one. We got II to 57. So some traders will buy above 57 since it's an inside pattern. And you get follow through. Bull's got two legs up here in this relatively tight channel. And you can see 63 essentially breaks the trend line. And we get a bear close. So trend line break and bear close. And then you get a big bar on 64. And 64 is important because if you think about it, what would bulls have to do on 65 to make you want to buy? There's not much they can really do. So I think that is, it's pretty clearly always in short on the close of 64. And if you're an always in trader and you sell the close of 64, there's never really a reason to get out. You can pretty easily make 30 points on this move. If you're, more micromanaging your trade, if you sell the close of 64, 65 is a bit disappointing because the breakout fails. So some traders will exit on the close of 65, which is why we rallied above 65. If you think about it, if you're selling 64, you're saying that we're going to break out of the bottom of this trading range. And when we fail to break out of the bottom of the trading range, a lot of traders will quickly buy back their shorts. And that's what causes 66 to rally. 67, we tried to form a double bottom, but, we failed. And so any bulls who are front running this double bottom are disappointed in the fact that we sold off after we started to rally, and they'll sell out of their longs. And that's what causes 68. I think you can manage this, if you sell 64, you can manage it either by getting out quickly on the close of 65 and selling again below 68, or you can just sell and you can hold because it never went back to always in long. And, if 67 closes on tie, you have to get out above that. You can probably buy above that. It's a double bottom. But technically, if you sell below 64, there's never really a reason to get out at all. But if you did scalp out, you need to sell again below 68. We get followed through on 69 and 70. 71 is kind of a tough call because it is an inside bar, and sometimes inside bars, you'll get a pretty good bounce on them afterwards, but it does not flip the market to always in long. And, you're paying attention at this point to, can we get back to this low, right? Can we get back to here? Can we get back to here? Are traders going to be able to buy here and buy more lower and make money? Are they going to be able to buy here, buy more lower and make money? Are limit order bulls going to be able to make money? And some traders, they bought below here and they're going to add above 71 and hope to be able to get out at break even. I assume we got to about, if you bought below 68 and you bought more lower above a bull bar like 71, that's pretty much exactly where 72 went to. So that's probably one of the reasons we sold off there. But if you do exit above 71, you can put a sell stop order right at a new low. And so if you get a bear bar closing near its low, you can just sell the market below the bear bar, like over here. But sometimes you get big bars like 73. So you can just sell the breakout point below 70. And why can you sell the breakout point below 70? Because a lot of bulls who buy above 71 are going to put their stops below 70, thinking that, well, it's the low of the day. And if we go below here, my premise isn't really valid anymore. And so, you want to be selling, you want to be shorting right where weak bulls are selling out of their longs. Because if you think about it, if they're selling, that's adding to the selling, and you're selling, that's also adding to the selling. So if bulls and bears are selling, the market's likely to get driven in that direction. And so you can sell below this low and you just get, keep getting follow through. I would not exit above 76. It's, maybe you get a small bounce, but if you get follow through, you can just get out. I think it makes far more sense to just stay short. If you do get out above 76, you need to sell again below 77 and probably be short into the close. And basically, so yeah, those are the two ways that I would manage selling below 64. I think 64 is a very credible sell. Like I said, strong bear bar, bulls aren't going to want to buy. And so, to conclude that, in general, sell below 64, either scalp out, disappointed somewhere in here and sell again below 60, 68, or just hold short. Maybe scalp out above 71, sell again, on the breakout point, or just hold short. And maybe scalp out, sell again, or just hold short. Something else that's important is this is a really tight channel, and tight channels are breakouts on higher time frames. And so why is that important? Because when you get a pair of bull bars or a pair of bear bars, there's a 60% chance in general, for example, here, that you're going to get to the measured move, down of your bear bars before you get, before it goes above the high. So basically 60% chance we're going to get down here before we get up here. And that's important because if you look at, the 15-minute, it's you get a lot of strong bear bars. You get these strong bear bars. Well, we're probably going to get a measured move down to this, and it's a tight channel. It's a tight channel on this one too, so it gets you thinking. Well, if it's tight channel on here, maybe it's an even higher time frame where it's a breakout. So it is a breakout somewhere, and you can see here on the hourly chart, this is a breakout, and it's a huge problem for the bulls. Bulls are going to buy below essentially the 12 o'clock bar on Wednesday. And they're hoping they're going to be able to buy more lower, and we're going to bounce back up, and they're going to be able to make money. So I think this is going to be a really important support point over the next couple of days. Can we get back to this low? And if we're not able to, that means bulls are trapped and they're not able to make money. But right now, this is a big problem for the bulls, and the best they can probably get tomorrow is a sideways day. And same thing, over the next 10 bars or, next 3 or 4 days, we're probably going to be pretty sideways. And once we get back up to here, maybe 4,500, if we do get back up there relatively soon, you can be expecting, a failure. So, that's basically it for me on the day.